When it comes to your wealth, tax is a weapon of mass destruction. If you don't keep tax to a minimum, your money will slip through your fingers. We all know that money, properly invested, will compound over the long term into huge sums. But how can it grow if the taxman has his hand in your pocket?
While the UK tax system is set up so that the less affluent generally pay less tax, those with even a small amount of money will find that they are taxed at every possible point. You pay tax when you drive to work, you get taxed when you get paid your wage, you get taxed when you spend that wage, you get taxed when you invest, you get taxed when that investment performs well, and you get taxed when you die.
We're not saying that taxes are necessary, as without it a country couldn't function and we wouldn't have any of the amazing public services that we do have. But it is your duty to ensure that you utilise as many of the legal methods as possible to avoid paying tax. In the long run, a wealthier you will actually end up paying more tax, so it's a win-win situation. In fact, many of the tips we're going to share in this video are deliberate government schemes to encourage certain behaviours, such as investing for your old age. So in one way, the government want you to pay less tax, unless that's a left-wing government, that is.
Avoiding tax is not the soulless evil act that the left-wing media would have you believe. In this video, we're going to look at a few ways to dodge and avoid tax legally in the UK for the benefit of you and the economy. Let's check it out. Welcome to Money Unshackled, the investment and finance channel that sets you and your finances free. This is Andy, I'm Ben, and if you like what we say, hit that like button and click subscribe.
And be sure to check out the offers page on moneyunshackled.com, where we are proud to bring you cashback offers, including one from LendingWorks, a top-rated peer-to-peer lending platform. You get a £50 cash bonus when you open a new account and invest £1,000. You'll also earn interest of up to 6.5%. Now let's get into the video.
Tax avoidance versus evasion. These two terms do sound quite similar, but there is a crucial difference. Tax avoidance is legal, but it does come with grey areas based on the extent to which tax is avoided. Those grey areas are usually reserved for the very wealthy and almost always involve clever tax advisors.
Tax evasion, on the other hand, is illegal. It's as simple as that. This involves not paying taxes by underreporting income or reporting illegitimate expenses. We believe this to be quite common amongst people who are paid in cash. Without a digital record of a transaction, it is quite easy to underdeclare income and therefore pay less tax. You probably know many professions where this is rife. Anyway, let's look at some of the legal ways to avoid tax.
Number 1. ISA. UK investors can invest tax-free through an ISA. Well, almost tax-free. By using an ISA, you don't have to pay any tax on interest, dividends or capital gains. It truly is the ultimate way to dodge tax legally, and the government want you to take advantage of this. After all, a nation that saves, or better, invests, does not rely on state benefits later in life.
Some investors have even managed to build up an investment pot of over £1 million, which was not only helped by the absence of tax, but can also be withdrawn tax-free. That's right, whatever you withdraw from an ISA is tax-free. Don't be put off by the intimidating name. An ISA is simply a tax wrapper that prevents the taxman from getting his filthy mitts on your money.
At time of filming, you can invest £20,000 a year into ISAs, which can be spread how you want across all the different ISA types, including a stocks and shares ISA and an innovative finance ISA, which is used for peer-to-peer lending. We've previously done a video on the different investment account types, including ISAs, and we'll link to this in the description below.
Number 2, pension. These have pros and cons. With the age restrictions on when you can withdraw from a pension, they are obviously intended as a way to save for retirement. This is not ideal for the likes of us who want financial freedom today rather than at old age, but nevertheless they are good for some people. What makes pensions so amazing is that whatever you contribute will get topped up by the government, known as tax relief. Better still, the amount that you receive is based on the amount of tax that you would have originally paid.
Therefore, if you are a basic rate taxpayer, you get tax relief at 20%, while a higher rate taxpayer gets tax relief at 40%. What's interesting is how the maths works. If you were taxed at 20%, then you actually get your contribution topped up by 25%. Imagine you were paid £100, which was taxed, so you received £80. If you pay that into a pension, you will receive an additional £20, which is 25% of £80. For higher rate taxpayers, this works out as a 67% top up.
Furthermore, if you die before the age of 75, then the entire pension pot can be inherited tax-free. But just a reminder, we are not tax advisors, so please do your own research.
Number 3, tax-free allowances. For those building up large amounts of wealth outside of an ISA, maybe those who have used up their ISA allowance or investing in an asset type that cannot be put into an ISA, such as buy-to-let property, you still have some generous tax allowances.
We often ask questions about paying tax outside of an ISA, but in many situations, no amount of money needs to be paid because you get generous tax allowances. You get a £2,000 a year tax allowance for dividends and a £12,000 capital gains tax allowance.
One technique that is used if you have built up a large shares portfolio outside of an ISA is to sell shares up to the £12,000 capital gains threshold each year. This way you realise the gain, but no tax is paid. For example, you could sell £17,000 worth of shares that you originally bought for £5,000, realising your £12,000 gain in that tax year. Then you could save the rest of your shares portfolio for a future tax year.
Finally, don't forget that these days the interest is paid gross and you get a personal savings allowance of £1,000 if you're a basic rate taxpayer and £500 if you're a higher rate taxpayer. These are not going to make you rich, but they are nice to have. The interest that you receive from your bank or even peer-to-peer lending is covered by this allowance.
Number 4, be self-employed or own a company. For employees, everything you buy is with after-tax income. This means that you are being taxed on the money that you earn before you can spend it. To us, this seems so unfair.
But the wealthy often pay tax after they have spent their money. This works because they own businesses that get to take advantage of the phenomenon known as tax-deductible expenses. While this might send the average person to sleep, those that are still awake will know that this is often a major factor in how business owners get rich.
Many expenses incurred while running your business can be deducted from your profits, thereby reducing the tax you pay. We have heard of people who have even gone on holiday, but as long as they have one business meeting whilst away, they can claim it back as a business expense.
Before you rush off to book that holiday, we suggest that you speak to an accountant to clarify exactly what you can and cannot claim.
Owning a company is the best way to avoid tax legally. The tax on companies is much fairer than the tax on human beings. And paying tax on money before you've received it, like you do as an employee, is the chump way of paying tax. Company owners can pay tax on the money that they earned almost 2 years after they earned it, meaning that they can spend that money on making more money. Number 5, transfer assets to your spouse. If you're fortunate enough to be married, or unfortunate depending on your view, then you can transfer investment assets to your spouse.
This might be useful if your spouse is a lower earner and therefore may pay lower income tax rates. You can even use their ISA allowance to pay no tax at all.
For instance, you could buy investment property in your wife's name, which is a great way to save on tax. This is especially useful for buy-to-let property due to the inability of higher rate taxpayers to be able to reclaim mortgage interest as an allowable expense.
Question of the day: what other ways do you know of that allows you to significantly pay less tax? Let us know in the comment section. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.